Well, this was a pretty strong week, solid bounce. The market's still not fully recovered. Like we still could be possibly putting in a lower high, but we are above mid-vamp now, so that is a good sign for equities. But what I do want to talk about today, we've been getting a lot of questions around gold. A lot of people asking, like, is gold going to continue higher? Has it topped? What are our thoughts on gold? And I know gold and a lot of other metals kind of have been part of all of one trade. There's been a and gold is a part of that. It's not really driven fully by uh, inflation expectations or anything like that. You could look at inflation swaps. It's definitely not inflation expectation related. There's theories of debasement and all that, but I think really what it is it's a metals theme that's been going on. And I'm curious to hear, Gamma, what your thoughts are. Do you think gold has topped? Do you think it's going to keep going? What are your thoughts around it?
So I do think that obviously we've been covering gold for a while now on the podcast, back and forth, right? Our theories on it, but I do think that gold has put in somewhat of a correlated run with commodities as a broad basket. Now, what I mean by that is, in general, gold is almost seen as like this odd commodity where in a recession, it can go up while commodities go down, right? And I think the key here is that gold is essentially one of these assets that global central banks will buy, right? Where like they may not do the same, they don't do the same with copper and etc. So there's obviously this foreign investor demand, investment basis demand for gold beyond just a typical trade, industrial or construction metal or production metal. And that has been the history of gold since the beginning of time, right? Like it's always been like this currency-esque type of metal. Now, where we are today, I think that what's happened in the last year and a half or so is we've had these huge. There's been this sentiment drive towards fears around deficits and um, de-dollarization globally, and call it reserve security, right? With Russian sanctions and all these things that has propped up the price of gold quite aggressively. Now, I'm not saying gold's a bubble or it's going to burst, it's going to fall significantly, but what I will say is there does seem to be this factor behind gold that is the metals trade. So, for example, even things like rare earths, which have pulled back a little bit, but off their highs, but are up a lot as well. Like everything that's related to this type of scarce mineral, the idea behind a scarce mineral, anything really in that realm, has rallied a lot. And I feel like a large part of gold's back half of the rally, right? Pretty much call it since like pre midsummer, last call it 500 points on gold to the upside, has been more of this correlated metals trade. And what I mean by that is look at, like like all these other metals, at least precious metals that have run as well. I think that it's something that you can't ignore when you're looking at gold. So the reasons why gold makes a good uncorrelated risk off play may have some wind taken out of its sails in the sense that like it may be more correlated to commodities and precious metals now than it was historically, or it used to be in its historic phases. That doesn't mean it's broken. It just means that if you get a massive disinflationary event where a lot of these metals get really really hurt, these precious metals, I don't see how at this stage where gold is right now, where gold is unscathed, it could happen. But I do think that there's like this downside risk to gold if disinflation really accelerates here and inflation impulses were to go bearish trend and beyond, right? Lower.
Yeah, we can already kind of see a bit of a correlation to stocks at the moment. Like whenever the stock market sells off hard, you could see it reflected in gold as well. So there is definitely a correlation there. Obviously not one to one, but I think it does have a lot of hype behind it at the moment. And I think that what you were saying there, where it's not really going to be the best risk off play, I think that's That's a good point. I think it's got a bit too much correlation to risk on assets at the moment.
I mean, just put it to you this way, right? Gold is up significantly in the last, like we're talking, we could just take a look here. In the last year, it's up 60%. The world we didn't debase 60%. In dollar terms, we're up, right? This is quoted in dollars on my chart, but we didn't debase 60%. Commodities across the board are not up like this. So it's not to say that gold is, again, in a bubble, but the idea that gold's going to leg up another 60% from here, I feel like is a bit ill to think, right? Unless certain events happen. For
Unless there's
example,
actual debasement that happens.
yeah, exactly. Something along the sorts of that, like where the U.S. no longer is the U.S. type of thing, and you need a quick replacement for the reserve currency of the world, and like that's where I think gold basically becomes the door jam and steps in. But I don't think that is necessarily where what we're looking at the moment. So I'm not going to say gold's bearish, because at the end of the day, like, to sit here and say that gold is going to trade down in a recession is also a hard thing to claim. I just think that there's a lot of juice in gold at the moment, to where like maybe other assets that are more hated, hint hint, outperform gold in real economic stress, which we have yet to see. And maybe, we may not get that. Like, economic stress is not guaranteed, right? So I think that that's probably why there's some uncertainty there in gold for those reasons. That's probably why gold seems to be channeling at this point, around this area, and not necessarily its uptrend has stopped since the beginning of fall. It hasn't really gone anywhere.
What is the main reason that gold is even up in the first place? I hear theories going around all the time, like there's central banks are buying gold, but central banks have been buying gold for years now, and gold is only moving in the last 12 months. So I don't
Well, I
I doubt it's purely central banks. There's another reason out there. What do you see as
no,
the
it's
main
it's
driver?
definitely it's definitely, it can't just be central banks. I mean, it's impossible in terms of the scope of their buying pressure or buying volume compared to what's gold has done. It's not just central banks. I do think, like, so the space that we're in, this macro space, everyone's looking for direct correlated drivers. If it's cross currency flows, or if it's capital flows, trade flows or currency flows, or if it's maybe geopolitical risk, whatever it is, right? People are looking for an outright underlying driver to say, okay, A plus B equals C. But we know in markets that's not necessarily always the case. And the tangent that I'm going on here is, it's pretty simple, that I think a lot of things became active for gold, and they've kind of transitioned across each other. So a good example is the the sanctions on Russian assets and the confiscation of some Russian assets was a driver for gold for sure. Is it the entire reason that gold is up this much? No, it's not. That alone is probably not, right. Um, and then you also have this illusion of above trend inflation. So inflation is above target for all this time. Bonds have traded quite like garbage. That's probably another driver for gold, right? Gold, this idea that you're in this perpetual, like, out of range inflation state, where inflation is just above grasp and it's chugging along, and central banks are not doing enough to contain it. Therefore, another driver for gold. Again, we can go down the list here of additional drivers for gold, but I think the rule here is how it all comes together and how they parlay off each other. So at some point along this rally in gold, retail and euphoria entered the chat, per se, right? Where you kind of segued away from these macro drivers, and you essentially included and leaned on these emotional drivers. Like, a good example, people don't line, unless you're in a defaulting nation. In theory, people don't line up outside of gold shops because they are believing this macro thesis behind Russian sanctions, or they think that the Fed's current stance of monetary policy is not restrictive enough with inflation 100 basis points over target, right? Like these are not drivers that get people out of their houses and into lines to buy gold bars. There's also a euphoric mechanism here that takes hold. And that's the thing that I think is the most dangerous behind gold at the moment. And it's not a reason to be bearish, but it's something to acknowledge that you're not long that boring gold. You're not long that boring metal asset that everyone used to just chuck away as like, oh yeah, gold's stable. Like gold's moved significantly, and I think the last leg of it has been very emotional. So you've introduced this property that is typical to risk assets, right? Things that have emotion. Think of like the FANG names, Bitcoin, right? Obviously different vol structures, different characteristics, but these are things that have this nature of emotional attachment where like hard up moves and hard down moves create these emotional drives to buy and sell. On the contrary, the one thing I could say that gold probably has working in its favor compared to these other assets is the nature of its physical trait being the ability to really buy and hold physical gold. And what I mean by that is like a lot of people that lined up to buy gold, the odds of them lining up again and going through the process to sell gold, there's a much higher friction there on transaction basis to get that gold to move again. So you have this situation where gold could very well have this period of lullness, right? We like to say that gold does a lot of moving in a short period of time and then a lot of nothing in a long period of time. And could we be on the precipice of that period where gold doesn't really do a whole lot going forward? It's very possible. Now, that's something that the trends will help us decipher. So right now, gold's in a bullish trend. It's above mid-vamp. So it has tailwinds to the upside. Gold could go up. There are other assets that are also in bullish trend above mid-vamp, and they also can rise, bonds, for example. But I do think that gold has seen such a historic run that there may just be some hot air that has to come out, and it may not be this straight selling pressure, but it could be something as simple as ranging between 4250 and 3850 or 3800, for example, like basically upper vamp to Momo in this chopping zone. It could just do that for a while, and that would be enough to annoy people, but it's not necessarily detrimental to the price.
Yeah. And what you mentioned around gold being the alternative to bonds lately, I think that's also a risk in gold. If bonds really start doing their job and being that risk off hedge that it's supposed to be, that's when you're going to start to see some capital move from gold into bonds as well.
Yeah, I think that's probably another area that's underappreciated at the moment in the macro space. And it's not necessarily because we may have a position. It's not necessarily because we have feelings towards one or the other. Obviously, we prefer one of them at the moment than one over the other. But I do think that the idea that gold theoretically dethrones gold, I mean bonds dethrone gold, is ludicrous. Like I do think that there's a place for both. But I also do think that new flows, there'll be a different price function. There'll be a different reaction function in gold and bonds depending on where inflation expectations are. So here's a great example. So right now, inflation swaps, they've done they made a whole lot of progress here the last like 45 days to 60 days. Swap spreads are pretty much up towards zero. Now, simply what these spreads are measuring, they're measuring the difference between the 10 and 2-year swap. So what you're seeing when we talk about and when you look at swap spreads collapsing towards zero, you're essentially seeing the curve normalize. What you want to see on inflation swap spreads like the 10 and 2s that we track and we show on X is a positive value. It indicates that the 10-year swap value or inflation expectations over 10 years are greater than that of 2 years. When it's the other way around, it signifies that the market is expecting short-term inflationary shocks versus longer-term trends, right? Because if the spread's negative, so let's take a look at the spread again. If the spread is negative, meaning the 2-year inflation expectations are higher than the 10-year, it's implying is that inflation expectations over the next 2 years are greater than those of the next 10 years. And that's just a signal that like there's inflation stress today that would be normalized over the longer time horizon, and therefore you have shorter term inflation problems than you do longer term. So there's inflation stress short term. The market's seeing that, and I think that in an environment like that, right? Like let's take a look at what this looks like over a longer time period. Pretty much since Trump won the election, inflation swap spreads went negative, right? And they bottomed out shortly around or after Liberation Day, right? And what this basically tells you is, in the most simple approach, the reason they dropped the way that they did when Trump won is the market had to start pricing in tariff risk. And tariffs are, and fundamentally, we understand that tariffs are not inflationary in the sense that they dethrone longer term inflation expectations, because if you hike goods 100% this year with a tariff, they're not going to be hiked in perpetuity, right? There's a cap to that price raised. It's raised once. And in reality, it actually affects demand too. So there's, in some ways, it could be disinflationary or even deflationary, depending on what the goods are. Long story short, you're not going to get the CPI readings every year for the next 10 years that show that 100% price hike. It's once and done, right? The Fed tries to allude to this aspect when they say tariffs are short-lived. The reason they say things like this is because they're actually just not allowed to say transitory. It's just like in their black
Yeah.
book. They can't. But like every time Powell's on stage and he's like dancing around the question, you're like, okay, he wants to say transitory. He knows that he's going to maybe clowned if he says it because of the big 2022 dilemma, which we can actually even see on these swaps. So let's go back to 2022. That's when inflation swap spreads blew out badly. And what this was signaling, and what we'll do is we'll go back to the single components. We'll break it down to twos and tens. This is just telling you that short-term inflation expectations are significantly above long-term inflation expectations, signaling high short-term shocks to inflation. And we can see that just by going to the spread breakdown. Like you can see this. This was the 2022, 2021, supply chain disruption, an inflation run that we saw post COVID stimulus induced, right? And that's what we saw here. And we go back to the swap spreads, and you'll see that like this was a very deep and prolonged issue. And they've since recovered, and now they're back towards zero again. But this was a period where bonds did not do well and gold did better, right? Gold inherently was a better holding than bonds, right? And I think that what this is signaling, this going back to positive territory, is almost telling you that the playing field is leveling out here. Like you don't really want to be, I don't want to say this the wrong way, but you don't really want to be long bonds when the spread's negative. It's not the most ideal. But macro and in investing, in markets in general, having these binary filters, right, are not really a conducive to accurate position modeling. So what I mean by that is, aka if spread is negative, don't own bonds. If spread is positive, own bonds. The reason why something as simple as that doesn't work is markets are forward looking. So if markets start getting the hint that the swap spreads are falling apart, it may be way up here where bonds are no longer optimal, or it may be somewhere along the road where the market starts to break on the idea, because you have scenarios where the swap spread can flirt with zero and revert. And ultimately what we're looking at here is if inflation swaps are controlled long term, right, and the swap spread starts climbing, that's incentive. That's telling you the market's basically discounting inflation risks in the short term and really pricing in disinflationary risks. And that type of price momentum is what will fuel the demand for bonds, and it does for gold too. It's not just a bond thing, but when you have this environment where everyone's kind of ignoring bonds and focused on gold, and you get this reversion in impulse. These aren't really impulses. These are just, in a way, they're impulses. They're market measured impulses of inflation expectations, but they're really just inflation expectations, right? So when inflation expectations turn into a more call it supportive stance for disinflation and not higher inflation, then this whole theory between nobody wanting bonds and gold being the better buy, like don't buy bonds, just buy gold, becomes tested, and it's something that is put to the test. And that's where you end up in a situation where you can have periods where bonds outperform gold, and vice versa, obviously, given, if we were to peak out here and fall further into negative territory. So I think where we are right now is we're seeing this reversion towards zero. Bonds seem to feel like they've gotten a lighter vest. Their weighted vest has gotten lighter per se, right? They're not necessarily as top heavy as they once were. And if the spread goes positive, it would actually be the first time since Trump was elected that the spread goes positive. And that's telling you one of two things. And we're going to wrap up inflation swaps here in a second. You have to understand what's driving the move. So here's a good example. If the reason the spread is going, and this is why you can't just use arbitrary spread values, right? Because let's just say the spread goes positive, and we know the spread is the difference between the 10 and the 2. And we're going to keep this very simple in math terms. So we know that a positive spread means the 10, the front is bigger than the back. So 10 is greater than 2. That's why the spread is positive, right? But if the spread is rising into positive territory because the 10-year inflation expectations are ripping faster than 2-year, which is not necessarily something that would happen because it would be weighted on the front end, but it's theoretically like the bear steepener idea, right? Where the longer end is just rising faster than the front end. And the issue there would obviously be, it would not be good for bonds.
Yeah, that would be
Right.
like
So
long-term structural inflation being priced in.
yeah, but like again, the odds of this happening without lifting twos, it's just not the same. It's not as serious. You know what I'm saying? Like it's just not. You would lift twos as well in the process quite a bit. If anything, twos would lead the way, right? Like you saw. Like here's a good example. Like um, go back to five. Let's go back 5 years, right? Like tens were ripping, but twos were just carrying the way forward. And this was a structural inflation issue, which ended up being transitory, but it was not at the. It was for a couple. It was elevated for a few years. So it's more unlikely than in the bond market for this to happen. But just understand that there is nuance in how the spread recovers to zero. It's typically done with the front end falling faster than the long end inflation expectations, which are good. But I think for bonds to truly see what we want them to see, we want 2-year, we want the green line to be below the purple, which would send the spread positive. But we want both of these spreads to fall in tandem, right? We want the long end spreads lower. We want the long end swaps lower. We want the spread between the two up because we want the front end down more than the back end. Essentially, again, very simple terms. We want the green line falling faster than the purple line, but we want both lines falling in tandem. We don't want, long end inflation expectations to just hover around because that's not going to do anybody any good. That's essentially just saying that you're going from transitory inflationary shocks to transitory disinflationary shocks, and you want a structural shift in the level of both of those values. But that we can leave it there for inflation swaps.
Yeah, let's talk about Bitcoin now. We finally got a bounce in Bitcoin. The cascade is over. that was that
It's
was an insane cascade. But yeah,
well,
like we got the fish trigger. Fish trigger snagged it, so that was pretty cool. That
that
fish trigger surprises me all the time.
let me enable that quickly on DDAP. So the fish triggers our exhaustion signal to the downside, and it triggered on the 21st, which is pretty much the candle low. Now, if members are watching this, earlier this week, we pushed a DDAP update on TradingView. As you can see, my DDAP is 2.1. So you should have the 2.1 version on your charts. This is just a reminder. Podcast will go back in a second. Just know that you should have 2.1 on your charts. If you do not, if it just says DDAP, you need to update the indicator, and you can go to the announcements tab or check your email on how to do that. So anyways, back to Bitcoin. Yeah, Bitcoin bounce, great bounce so far, but it's a great bounce off the lows, but structurally it's not that impressive in terms of being able to show signs of the bearish momentum shifting. And what I mean by that is for things that really accelerate to the upside, Bitcoin needs to clear mid-vamp at least to get a real squeeze going. Now, for those following, we all know that the real trend is tested at 111 at this point, but that's so far away that we don't even pay attention to that at the moment. One step at a time, right? So the first step is just clearing mid-vamp, and it can't even bounce to that.
Yeah,
So
it's definitely looking weak. Like if a sell-off like this happened in the Nasdaq, we would have a fat like 5% candle once we put in a low. Like it's not even able to do that.
Well, speaking of that, like take a look at the Nasdaq, right? So the Nasdaq sells off, and we actually almost get the Momo touch on QQQ, very close. We're at lower vamp. We bounce back to mid vamp. We break above mid vamp the last 3 days. By the way, we're essentially one time framing off the lows here, right? Like every day we haven't taken out the low of a prior day on the Nasdaq. I'm not talking about future. I'm talking about regular trading hours, right? So we bottom out on last Friday, and it's a gap up, and then we don't take out the lows any of these days. So we essentially one time frame up, very simple. Now we break mid vamp to the upside. So price does seem to have recovered in the sense of structural repair has been quite swift here from the lows. The next test for the Nasdaq is going to be, does the dip hold at mid vamp? Does the next pullback, whatever we do, odds of us just one time framing, like I said, if every day basically holding, and we take a line here and we go from the bottom, the odds of us doing this, the all-time highs, is pretty low, especially given we're in a risk-off regime. So the next key is to see if mid-vamp can hold on dips. That would be at least a sign that the trend on Nasdaq is essentially intact, and the regime model is the only thing holding you back, which, as you guys know, we need double factor confirmation. We need the trend and the regime to be aligned. The only thing holding us out of being long Nasdaq at the moment is the regime is not aligned. So at that point, if trend can hold, which it seems to be doing right now, the regime flipping back to risk on is what would send us back into long Nasdaq. The fact that we're not looking remotely close to doing that on the regime map is what has us concerned that we're just looking at some more chop down the way here on stocks. So that's why I say, if you're trying to play tactical outside of our regime process, you're just trying to say, I want to be long stocks. Well, at this point where you are right now, dips to mid vamp should hold. So if you want to say, I just want to be long stocks, I don't really care about no macro regime, which obviously that's not our take. The bare bones minimum I would expect from price at this point is to hold 607, basically 607 to 605 on QQQ. If we can't hold that on a retrace, then you risk going back below mid vamp and rotating back to the lows. So I think that's probably the most simple and straightforward approach for Nasdaq at the moment.
Yeah, and Bitcoin kind of similar, except this bounce needs to
No,
get to mid vamp. Like
yeah,
if you are someone that bought the dip, mid vamp being the target, I wouldn't even risk trying to hold it past mid vamp. This bounce looks pretty weak.
and obviously we have a holiday weekend. We have a bunch of regular markets closed tomorrow, partial day Friday. Bitcoin's going to trade, all these days like it always does. So there's going to be more activity in Bitcoin by Monday than stocks, and given it's only Wednesday now, right? So there's going to be some period here where Bitcoin can do something. I don't know how much it's going to do, but I can tell you that it's kind of but it's worrisome that after we have this major cascade, we're what, 1, 2, 3, 4, 5. We're on the sixth session off the lows, and we haven't hit mid vamp yet. Like you can see, look, here's a good comparison from the lows on Nasdaq. We hit mid vamp, and we can go back to a real crash like here, right? So these aren't like hard cascades. These are just here, like we go and we bounce, and it's these lackluster bounces. This is more event driven. I don't want to use something like this. Let's go back in time. So you have these like strong cascades. Price reverts to mid vamp rather quickly in equities, right? It's just a normal flow. Now, Bitcoin seems to be weighed down by more negative pressure, which is to be expected. We're in a risk off regime, guys. So like this kind of weakness in Bitcoin is not really surprising. If anything, it's the strength in equities that's a little surprising. It's not Bitcoin. Bitcoin is actually the asset that's making perfect sense right now to what's going on.
Yeah, pretty much.
It's stocks that are playing the confusing game here. It's not Bitcoin. Bitcoin's telling you the regime flipped over a month ago, and Bitcoin reflects that. Now stocks, they do in the way where they haven't really gone anywhere, right? So like Nasdaq is essentially sideways since the regime pivot, essentially. And we've had a whole lot of vol in between. Again, that's risk off style. That's a risk off style to have an increased regime of volatility with little to no price gains. That's risk off in a nutshell. Obviously, risk off also includes falling prices, which we're not sure here that if this is going to hold or not. But if this continues to chop around, it would just make sense. Risk off. It's what we expect. I would be pretty shocked if markets go to all-time highs from here. I think you as well, right?
Yeah, definitely. I really don't see it. If anything, if we do get to all-time highs, it's going to be due to a squeeze, not really due to any fundamental reasons on the economy. Because clearly the system is telling us the economy is deteriorating.
Yeah. Now, how that plays out and how the market picks up on it, it's interesting because, like, you take a look at bonds, right? Bonds have been doing this weird thing. Like, if we look at the terminal rates are not at like macro, like the lows of the cycle here, where what we were used to in the last couple of years, where flirting with the 2.8% line. We're still around roughly slightly under 3. Like, terminals are not printing new lows for the cycle, right, over the last 3 years. So that means rate expectations are not lower than where they were at any point in the last 3 years. So it's not like bonds are being driven solely by rate cuts. There's some other driver here, and one of them, well, as we spoke about earlier, the inflation swaps, right? This is probably a driver, this disinflationary pressure on swaps, this collapse on short-term short-term inflation expectations, and that drive up in the spread is probably acting as somewhat of a tailwind for bonds. A fall in term premium, even slightly, another tailwind. These are things that are like on the outside of just rate cuts. So I think that my guess is if bonds break out hard from here in the next couple of weeks, that's probably something's probably cooking, I'd guess. Bond market's looking for something. And that would make more sense than what I think a lot of people are looking at right now, saying like, oh, the stock market's bouncing, everything's okay. Well, if everything's okay, right, there should be this positive drift to bonds because of this resolution to inflation expectations. But bonds should not move significantly higher if everything's okay, and I think that's going to be the test here. If bonds break up and out, then you have something to worry about.
Do you see a scenario with positive stock bond correlation on the way up, and what needs to happen for that scenario?
Yeah, so there is this. I mean, you're kind of seeing that right now, to be honest, right? Like, you're kind of seeing that last even just a couple of days where stocks and bonds are moving up together. And this is where it gets kind of interesting. So I think there is a possibility that if inflation expectations do die down and they fall in tandem, I don't want to say they fall consistently, and bonds are allowed to rise in tandem with stocks due to lower inflation expectations and possibly more dovish policy at the Fed, at least on over the next couple of years, not just the next meeting, right? That enables this regime where stocks and bonds can go up together. Now, it may not be as aggressive. It's not going to be as aggressive as the other way, right? Like, when people think of the stock bond correlation, they're like, oh, when bonds felt like this, if stocks rip, are bonds going to rip like this? It wouldn't be something like that. I think it would be there, but it would be more muted, where bonds don't move up as aggressively. Bonds, the best bull runs in bonds happen in recessions. That's what it is, or in periods of high economic stress that aren't inspired by a desire for the rest of the world to dump U.S. assets. For example, Liberation Day was a stressful event, but it was driven internally, right? It was an internal event, not so much economic event. It was an internal policy event that deterred foreign investments into U.S. assets, and that is a bit different than the traditional risk-off scenario.
Yeah. Well, do you want to wrap it up there? Get to the Q&A?
Yep, we could definitely do that. So thank you guys so much for listening. If you have any questions, feel free to reach out to us on X @TheMarketRadar, or go to our website at market-radar.com.